David, how does the picture look to you from here for the market for the rest of the year with so much now baked in terms of Fed easing?
Yeah, our view is really not too different from Jonathan's, actually. I do think that there is a fair amount of good news priced in. We're back near all-time highs, as we were just talking about. But also, more importantly, we're near the high end of the valuation range as well. So I think from here, you're going to have to see earnings come through and drive the market higher, and we think it will. But it's going to be a moderate earnings growth picture, and as we were just talking about, the global economy is still decelerating a bit, and until it starts to inflect a bit higher, that we have to wait for that to see the real upside. The other variable, obviously, is on the trade front. If there is some sort of resolution between U.S. and China, that could be a significant positive catalyst. That's not what we're expecting at this point, though.
David, you mentioned both trade and earnings, and just to bring those two things together, it seems as if analysts are kind of procrastinating in really radically revising earnings expectations almost to see what happens on trade, at least for a lot of sectors. You've had the 2019 consensus forecast for the S&P basically go flat, which is still anticipating a bit of a bounce in the second half. Are there risks to that idea that we're going to just actually have a little bit of a renaissance in the back half?
I think the biggest risk would be if the U.S. moved to tariff the full basket of Chinese imports. I think most of the tariffs that have been announced so far are largely reflected in the estimates, and we've seen that. We've seen it impact industrials and some of the semiconductor companies, especially. But if we do tariff the full basket of Chinese imports, I think you could see 3 to 5% downside in terms of earnings estimates, and that's not baked in at this point.
So this is going to be a key week. We've got the G20 that we've been waiting for coming at the end of the week. Jay Powell also speaks at the Council on Foreign Relations tomorrow, and so do a few other Fed members, including Jim Bullard, who was the one dissenter. In the near term, how would you advise investors to position around all of these event risks?
Like I said, for a guy who's been bullish now for I don't know, 5 years, I wouldn't be buying into this in the near term. Mostly because it's not about what happens in these meetings. We're not going to get this magical all-clear sign on China. I think this is more likely to be a
No, but you could get some sort of truce where they don't go through on the next $300 billion.
And we've seen that story for a year now, and then we back off a little bit, we go forward a little bit. So I think the more likely path is that this is going to be a slog on trade rather than we've been talking about quick resolutions on this thing for over a year. And the president has done a really good job of putting pressure on and then not letting the market get too upset and then fighting the battle again a little bit more later. So I think the most important thing is a week from now or next Monday, you have the ISM. It's been declining now since last August. Let's see what that looks like. My guess is it's going to be to the weak side. And then you have the employment report. We had a weak employment report. And if the market sees that we have a second in a row, we've had about 3 or 4 weak employment reports in the last couple of years, but every single time you bounce back and got something stronger afterward, it was a head fake. If this proves to be more than a head fake, the market's going to take it a bit more seriously.
Jonathan and David, thank you both very much.